Master Toastmaster, fellow Toastmasters, and unpresent guests. I'd like to start by saying we're living in a very exciting time in the history of financial planning. However, I'm sure you'll agree with me, we're also living in a very confusing time. Many Canadians are faced with some of the most important financial decisions of their lifetime, and many are concerned about saving for retirement and reducing their taxes paid to Canada Revenue Agency. Today I'm going to give you some answers. I'm going to discuss the benefits of RRSPs and how you can accumulate your wealth and reduce your taxes. First, I'd like to start by explaining the fundamentals of an RRSP. An RRSP is basically a box. When you put money into this box, it's a tax deduction, so it's taken off of your taxable income for the year in proportion to what you put in. Inside of this box, you can hold different investments. You can hold stocks, bonds, mutual funds, GICs, etc. And any investments that you hold inside this box grow tax sheltered. So any interest, dividend income, or capital gains that are accumulated inside here are tax sheltered, and you won't have to pay tax until you withdraw the money from your RSPs. And that's when you're taxed. But generally, because RSPs are used for retirement savings, you accumulated wealth over your lifetime, and then on retirement, then you're taxed. Generally, you're not working, and you're in a lower marginal tax rate, so you're also generally taxed at a lower marginal tax rate when you take this money out. Now, what do you think the major concern is that I run into with my clients when dealing with RSPs is? It's the fact that you take money out of, or it's the fact that you're taxed when you take the money out of the RSPs. And this is a misconception that most people have. The government have actually given you a refund at the beginning, so they actually own a portion of that money inside the RSPs. Let me explain. Let's say you want to invest $10,000 into your RSPs. Now at a 50% tax bracket, it's tax deduction, you receive the refund from the government of $5,000. So you've gotten this $5,000 back already. That means of this $10,000 inside your RSPs, $5,000 is yours, and the other $5,000 is the government of Canada. Now, over a 9-year period, an 8% return, your money will double from $10,000 to $20,000. Really, only $10,000 of it is yours. Your $5,000 has grown to $10,000, and the government's $5,000 has also grown to $10,000. I'm sure you can see where I'm going with this, but I'll do it one more time for simplicity. Your $20,000 goes to $40,000 9 years later, 8% return. Your $10,000 grows to $20,000. The government's $10,000 grows to $20,000. So now, if you wanted to withdraw your money from your RSPs, assuming you're at the same tax bracket, 50%, the government will actually take back their $20,000, and you'll receive your $20,000. So that's basically how an RSP works. Now that I've shown you the fundamentals of an RSP, I'm going to show you a financial strategy that allows you to maximize your RSP savings, provided you have the contribution room available. And this is called the double-up method. For 1 second. My pen walked away on me. So let's say you want to invest $1,000 into your RSP this year. At a 50% tax bracket, what would be your refund? $500. So you receive a refund of $500. What would most people do with $500, a $500 check they receive from the government?
Spend it.
Spend it. A lot of people would spend it. And if you spend it, you still have $1,000 in your RSP. Now what's another thing you can do with it?
Invest it.
You can reinvest it. Yeah, that would be a smart thing to do. And if you reinvest it, you'd have $1,500 in your RSPs. Now the third option, and this is what I recommend my clients to do, is called the double-up method. And what we're going to do here is we're actually going to borrow $1,000, invest it inside your RSP, and this will generate another $500 refund. Then we're going to use this refund down here and this refund up here to pay off your debt. The difference being now you have $2,000 inside your RSPs. Same amount of money out of your pocket up here, 3 different scenarios. Rhetorical question, which would be the best option? Option 3. So now I've shown you how RSPs work and a strategy that allows you to maximize your RSP savings. But I know that some people here may have maximized their RSPs, or they don't have the contribution room available to implement this strategy. So there's actually a new investment vehicle that just came out last year. The government of Canada allowed it, and it's called the tax-free savings account. And I'm just going to, it offers some of the benefits that an RSP offers. It allows a tax-sheltered growth, and it also offers tax-preferred income. And I'm going to show you just briefly how a TFSA works, tax-free savings account. So tax-free savings account, very similar to an RSP. Same idea, it's a box where you hold investments. You don't get the tax deduction going in, but the investments inside this box grow tax-sheltered. So again, you don't have to pay tax on capital gains, dividend income, or interest income earned inside of this box. And it grows tax sheltered. But when you take it out from a TFSA, you don't have to pay any tax on it. It's received tax-free. So unlike the RSP, you get the tax benefit on the other end of the box rather than the RSP. You get the tax deduction when it goes in. Here you get a tax break coming out. So that's how a TFSA works. So that's basically all I have time for today. So I'd like to thank you for listening. So go out there, and if you want to maximize your savings, make your money work harder for you by implementing a TFSA or an RSP into your financial plan and reap the benefits of tax-preferred income and faster wealth accumulation. That's your Toastmaster.
Can I have an appointment with you? At the end.